Welcome to another video. So in this video, we'll try and understand what are the 5 major income tax changes which will be applicable from 1st April 2025, or in other words, for financial year 25-26. Well, 1st April is the start of a new financial year, and therefore it becomes all the more important for us to estimate what is the income tax liability or plan our taxes based on the income that is to be earned for 25-26 financial year. So therefore, it is important for us to understand what are the 5 major income tax changes that will be applicable from 1st April of financial year 25-26. So we have each point and we'll go into each in depth to understand what are these 5 major changes. The first one, of course, is the new income tax slabs and rates. Well, one of the most famous announcements in the budget 2025 is the new tax slabs, which is applicable under the new tax regime. Of course, for the old tax regime, the old slabs will continue. So you have slabs in the ranges of 0 to 4, 4 to 8, 8 to 12 lakhs. Every 4 lakh you have slabs. And of course, you have a higher slab, which is basically above 24 lakhs and a high rate of 30%, which gets attracted. Now, because of this rebate under section 87A, because of this particular concept, up to 12 lakh rupees of income, there is no tax at all, or up to 12.75 lakhs of income, there's no tax for a salaried person. So this is the first major change that will be applicable for financial year 25-26 for finding out how much is the tax liability to pay. Second one is TDS rates and thresholds. Well, TDS or tax deduction at source is basically something that you should deduct as tax at the point in time when you make a payment to a particular person. You take the example of professional fees or legal fees. Now, at the time when you make a payment to a lawyer, the legal fees, you are bound to deduct 10% on that amount and pay the remaining amount to the lawyer. That 10% is something that you should hold back and pay to the income tax department, and that lawyer will get back the 10% when he or she files the income tax return. Similarly, you have some major changes as far as thresholds are concerned. 194I talks about TDS on rental payments. Earlier, the threshold was 2,40,000 rupees in a year. So in a year, if your rental payment to the landlord exceeds 2,40,000 rupees, then you are bound to deduct 10%. This threshold has now been revised to 50,000 rupees a month, which basically means that if your rental payments in a month is crossing 50,000 rupees to the landlord, then you are liable to deduct 10% on that rent payment and then pay the remaining amount to the landlord. Similarly, in the case of 194J or TDS on payments to professionals, in a financial year earlier, if the total payment to a professional exceeds 30,000 rupees, then again 10% was liable to be deducted on that payment. This limit has now been extended to 50,000 rupees, which basically means that in a year, if you are making professional payments to a particular person for more than 50,000 rupees, then you are bound to deduct 10%. Similarly, your 194A, which is basically TDS on interest payments that banks will pay you if you have an account with the bank in form of a FD or a savings bank investment or whatever. Earlier, for non-senior citizens, the threshold was 40,000 rupees in a year. If you cross 40,000 rupees in a year interest that's payable by the bank, then the bank will deduct 10% or whatever percentage of TDS. This limit has now been extended to 50,000 rupees in a year. And for senior citizens, earlier per annum the limit was 50,000 rupees of interest, TDS will get attracted. Now that limit has gone up to 1 lakh rupees in a year. In other words, if the interest that you receive from the bank is exceeding 1 lakh rupees in a financial year, then the bank will definitely deduct TDS under 194A. Second is the concept of TDS rates. Of course, thresholds is what we discussed now. There have been some important changes or reduction in TDS rates as well. Effective from 1st October 2024, especially in the section of 194H, which is basically TDS on the payments in the nature of commission, brokerage and all that. Earlier it was a 5%, now the rate has been reduced to 2%. Similarly, for few other sections also, earlier the TDS rate was quite high. Effective from 1st October 24, the rates have come down or slashed to 2%. One more change under TDS is the concept of no more increased TDS for non-filer cases. In other words, what it says is that if you are making a payment to a particular person and that particular person is a non-filer of income tax, then the earlier provision was that you are bound to deduct a double rate of TDS and TCS on that payment and then pay the remaining amount to that particular person. But effective from 1st April 2025, this double rate of TDS TCS is not applicable, which means that if you're making a payment to a person and that person is a non-filer of, it could be any payments, it could be rental payments, professional payments, legal fees, whatever, and that person is not a is a non-filer of income tax returns, you need not deduct a higher rate of TDS and TCS from 1st April because this concept has been done away with. The normal rates would continue to apply. Coming into the third important change, and that is updated returns. Well, what it says is that for a financial year 25-26, you have the original due date to file income tax return, which is basically 31st of July 2026. By July of the next financial year, you're supposed to file an income tax return. But say you miss that particular deadline, you still have time up to 31st of December 2026 to file income tax return. Otherwise, it's called a belated return. Now, what this concept of updated return tells you is that for financial year 25-26, from the last date of the assessment year, so the assessment year for financial year 25-26 is 26-27 and the last date is 31st March 2027. So from this particular last date of the assessment year, you have time or you have a period of 24 months. You have a period of 24 months from the last date of the assessment year to file an update return. So if it's 31 March 2027, you have time up to 31st March 2029 to file an update return if you have some tax liability that you're supposed to pay. So earlier it was 24 months, now it's increased to 48 months. In other words, you have 4 years from the last date of the assessment year being 31st March 27, 4 years time, 31st March 31 up to which you can file an update return. So earlier this was 24 months, now it is 48 months, which means you have 4 years time from the end of the last date of the assessment year to file an update return if you have some amount of tax that you want to pay to the department. The fourth change is something which the department is looking into very strictly, and that is review of the current as well as previous ITRs. See, what happens is that when you keep on filing ITRs for many financial years, the department will, with the intake of artificial intelligence and machine learning and all that, they are now analyzing each ITR components from one financial year to the other financial year, and then they are noting inconsistencies and discrepancies between the two financial years. So when you're going to file the ITR for 25-26, you need to keep in mind that the components that you disclose in the ITR, there should not be too much of deviation from the previous ITRs that you already filed. Otherwise, your case would be picked up by the department and these inconsistencies, the discrepancies will be highlighted by the department. Now, what they will look into, from when they will look into and all is not specified. But it is one thing is sure that from 25-26 onwards, the department is looking into this comparative analysis more strictly. And lastly, you have changes in TCS or tax collected at source. Well, TCS is basically a tax that is to be collected by the seller. Say you're buying a car from a car dealer. The car dealer will charge TCS on that car. The car dealer will put the TCS on the invoice and send you the invoice. So on particular transactions, on some specific transactions, TCS or tax collected at source will apply. Now there's something called as liberalized remittance scheme or LRS. Well, LRS or liberalized remittance scheme is basically a scheme under which the individuals can send up to $250,000 in a particular financial year. Not for companies. Individuals, when they want to send money abroad for any particular purpose, without the RBI approval, up to 250,000 USD you can send in a financial year. If you want to send more, then you have to get the approval from the RBI. So what it says is that under the LRS, for any kind of payment, if you exceed 7 lakh rupees or if you pay more than 7 lakh rupees in a particular financial year, the bank through which the payment is made will collect TCS. So this limit of 7 lakhs has now been increased to 10 lakhs effective from 1st April 2025. In other words, If you're sending, the upper limit of course is $250,000, but if you're sending in a financial year, all types of payments which come under LRS put together, if it exceeds 10 lakh rupees in a financial year, then yes, the banks will collect TCS at the rate of whatever is the rate that is prescribed for each type of payment. They will collect TCS if it exceeds 10 lakh rupees. Earlier it was 7 lakhs of rupees in a financial year. Adding to this, you have a couple more changes in TCS. If you have taken a loan from the bank for education and you're sending it to your son or daughter abroad under the LRS scheme, earlier there was a small TCS rate applicable. Now that TCS has been abolished or it done away with. So for education oriented payments abroad, if you have taken that money from a financial institution like a bank and you pay that abroad for educational purposes of your family, then there'll be no TCS on this particular transaction. Similar is the case when a person is selling. When a particular person is selling goods worth more than 50 lakh rupees in a financial year to a particular person, then that particular person or the seller was liable to collect TCS if the amount exceeded 50 lakh rupees worth of goods in a financial year. Now, this TCS rate has also been abolished, which means that in a financial year, if you're selling goods worth more than 50,000 rupees to a particular person, then you need not collect TCS from 1st April 2025 onwards. Well, I hope I was able to make things clear in this particular video and make you understand what are the 5 major changes. Well, if you like the video, do show your support to us by hitting the like button. If you want more videos like these on a regular basis by way of notifications, you can also think of hitting on the subscribe button. Till then, I'll see you guys in the next video. Take care and thank you.